Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are starting off another week on a fairly uncertain footing with regards to the US equity markets. This is really the first time we've seen a pretty significant deterioration of consumer sentiment, which has dragged down the overall market. We've seen a slowdown in terms of retail sales, consumer spending. In the last few years, we keep talking about, what if U.S. consumers starts to pull back on spending? Yet every single time we were concerned about that, U.S. consumers remained resilient in their spending across almost all income levels, all categories of spending. But we really have seen in the last few weeks a significant deterioration in the actual spending component for US consumers. And that is, at the moment, probably at the one of the biggest risks that we see here with the broader markets. Now, the FOMC meeting is coming up tomorrow. That's going to be a major one for us to pay attention to as expectations are high with regards to, a pretty significant change to the dot plot, meaning the Fed's expected rate path curve for 2025. At the moment, bond markets are pricing in three rate cuts. We'll see what Chairman Powell and the FOMC committee are expecting and see if whether those two things are in line with each other. Expectations are for, as the economic picture starts to deteriorate, for the Fed to step in relatively sooner than later to help support the U.S. equity markets and support cutting interest rates. So all in all, we find ourselves in a much more shakier environment here for equities. You have on the S&P 500, we broke down below 5,700, which is a major support level here. And note yesterday's rally here basically got us back to that 5,700 level here. And this is going to be a really important level here today, more so this week in terms of whether or not we can clear back above that level and kind of resume more neutral view here of the markets, because up until now we've broken below a major support level. We've rallied back up to that level as resistance, and if bulls want to maintain this market, they really have to clear back above 57 pretty decisively, I would say, in order for equity investors to have any confidence in this overall market. On the flip side, if we get rejected at 5,700, that would be also at the same time a pretty strong bearish signal here for the overall market. So this week is a pretty pivotal week here with regards to how we react to some of these major support and resistance levels. You have the NASDAQ 100, which hasn't quite gotten back to that support level here, which is coming around 500. We're at 482 right now on the Qs. So the NASDAQ 100 technology overall weaker than the broader market, and needing to see a little bit more upside here for technology kind of maintain that same neutral view. Otherwise, we maintain a more bearish view here for technology. IWM small caps, same thing here. We're kind of trading back below that 215 level here. We haven't rallied back up to that level just yet. So small caps underperforming here, the broader markets, and equal weight S&P 500. This is the first indice that did manage to clear back above a previous support level here. So participation here has been relatively broad. We haven't seen kind of a broad sell-off just yet. The sell-off is more concentrated right now within tech, within consumer discretionary, within mega cap names, rather than across the board. And that is one potential decent sign here of the shape of the US equity markets. We're not seeing panic selling across all 11 sectors across the board. We are seeing a few days of that, but overall, we're seeing the broader markets remain on the more resilient side of things. So that is definitely a small positive that we currently see here in the broader markets. So let's take a look at kind of where we stand otherwise to help us get a more complete picture. We continue to see value outperform growth by a pretty significant margin here over the past 3 months or so. We do expect commodities to start lifting off here a little bit. We've pulled all the way back to this 2180 support level here on GSG, with oil continuing to uh, lift off of those 52-week lows with kind of the geopolitical tensions rising again here in the Middle East. That's expected to increase the price of oil, and while gold reaches new all-time highs, that's going to provide a more supportive environment here for commodities going forward, at least in the short run. Interestingly enough, if you look at HYG over the last couple of weeks, this is really the first time we've started to see, high yield corporate bonds show a little sign of a risk-off environment. As you can see throughout this past year, bonds have maintained a pretty strong and resilient risk-on signal here for any concerns around credit quality. But over the last couple of weeks, we started to see some signs of deterioration. But yesterday's price action did manage to get these high yield corporate bonds back above 50-day moving average, which is a pretty significant bullish signal here for bonds. So right now, the concerns that U.S. equity markets have with regards to the strength of the U.S. consumer, the bond market doesn't quite yet share the same concerns at the moment. You have the VIX pulling back to that 20% level here. One of the reasons that we call the bottom here this week is really because of the fact that throughout last week, towards the end of last week, as the equity markets were continuing to decline throughout the week, we also started to see the VIX decline in conjunction with that. Usually the VIX and the S&P 500 are inversely correlated. When one goes down, the other one goes up. But towards the end of last week, we started to see where price action on the S&P was continuing to push new lows. The VIX was also starting to pull back here. And those two signals in conjunction with each other have historically made a strong signal for a market bottom, at least a temporary market bottom, and that's exactly what we've gotten so far. But like I said, that temporary market bottom has gotten us back to that major support level of 5,700 on the S&P 500. And our biggest question here this week is, can markets get above that level here, or are they likely going to get rejected and continue moving lower here? So a lot that's riding on this particular week with regards to the price action on the S&P, as well as the FOMC meeting coming up here tomorrow afternoon. You have 10-year yields continue to moderate around that 4.3% here, with bonds, catching a little bit of a bid here after pulling back after what has been a pretty strong rally. We have a small bit of a pullback here. That could be the continuation of some further upside here for bonds, meaning lower yields. You have the dollar continuing to weaken here around that 103.60 level here, and gold, as you can see, reaching above $3,000 for the first time, marching its way towards 3,100, which is our upside target here for gold. Really on the back of some kind of safe haven demand for gold. And look at oil. We've kind of touched that 52-week low here last week, and we're starting to trade higher from there. So expectations are for oil to continue to rise, especially as geopolitical tensions in the Middle East have kind of resumed again. So concerns around that are likely going to be driving oil prices here in the short run. And then looking at sector rotation, we've seen a fair amount of sector rotation here, with largely technology and consumer discretionary taking the major brunt of the sell-off here. Those are the two sectors that have been either strong or in line with the S&P 500 that have turned severely negative here over the past few weeks. This is really the question as to whether or not the equity markets, are a buy the dip opportunity or there's further downside here. We really have to look at these two specific sectors and see if they could start turning things back around a little bit, or some of the more offensive sectors also take on a little bit more strength here at the moment. And communications remains incredibly strong here over the past 6 months. Financials also remains incredibly strong here. XLF bouncing off this $47 support level here, actually looking like it's going to continue on towards that 52 level here to the upside. Consumer staples, um, showing some strength here, but losing a lot of that strength here over the last couple of weeks, alongside healthcare doing the same thing, showing a lot of strength here over the last couple of weeks, showing some weakness here right now. But note that the 50-day moving average has been held and respected. So the more defensive sectors still seeing a significant amount of demand. You see materials, start to outperform a little bit here relative to the S&P 500. You have industrials starting to outperform a little bit relative to the S&P 500. And then you have sectors like real estate, utilities, and even energy, as you can see, outperforming the S&P 500. So we're really seeing a lot of sectors, not just the defensive sectors, but even some offensive sectors like communications, materials, industrials, financials that are continuing to outperform the S&P 500. And that is, at the moment, somewhat encouraging here for the broader markets. If those markets start to pull back here, and then that's definitely more of a concern here as well. So, and home builders, as you can see, continues to underperform, even though interest rates have started to moderate a little bit here as well. And semiconductors, this is really one that I'm paying attention to here this week. We broke below that major support level at 210 on semis. Semis have been weak really throughout the year, and at the end of last year. So the fact that we broke below support, we're now coming back to retest this as resistance is a really important test here for whether or not semis can hold on. We've seen pleas from multiple CEOs to get behind the manufacturing capabilities of stocks like Boeing, Intel, stocks like that. And these are all contingent upon debt deals, fairly massive debt deals to go through. And Apollo will likely need some help, there. But we'll definitely keep an eye out here on kind of how financial institutions come in and support these specific sectors. So looking at ideas for this week, we're at a pretty pivotal week here right now. And the question, on a lot of investors' mindset is, do we buy this dip or is there further downside? Like I said, the early evidence here points to more of a healthy consolidation that we find ourselves in. So far the S&P 500 pullback here is about a 10% pullback, which is in line with historical averages of kind of pullbacks here. The average pullback is about 13% that lasts about 4 months long. So we're certainly on the short end of the curve with regards to this move. But in terms of the magnitude of the move, it's very much an average move from a correction perspective. So with the VIX putting in that temporary bottom here on the S&P 500 last Thursday, I think that there is a potential opportunity to play for a little bit of a bounce here right now and use a relatively tight stop on those opportunities. And the idea is that, if you want to try to capture a bounce back, you definitely want to do so as early as possible to have a favorable risk reward ratio, right? And basically have a stop below 5,500 so that if we do get rejected at 5,700 and the stock gets back below 5,500, which is the support level here, then I would say, that would invalidate any buy the dip thesis. And at that point, I would advocate more looking at more bearish opportunities here in the markets. So what we're going to do is we're going to explore some of our bullish and bearish ideas that we have here in the broader markets and how you can apply them in these type of market conditions, whether you're bullish or bearish on the overall markets. So, um, in terms of stocks that are kind of worth paying attention to here right now, all of the Chinese tech stocks right now have been outperforming. Kind of international equities overall has been outperforming here. Note on Alibaba here. We noted this kind of breakout here above 120 as a pretty significant one, and I'll pull up a weekly chart here just to kind of show you that zoomed out. That breakout here looks like this. This 120 level that's been a multi-year resistance level here finally broke out here a couple of weeks ago. This is when we first told you about this particular stock, and notice how after it broke out, it consolidated for 4 weeks, and now it's starting to break out higher here again. Our upside target here for Alibaba is all the way into the 230 level here to the upside from a fundamental perspective. Alibaba is trading at about 12, 13 times forward earnings, which if you take into account kind of the industry average around 22, 23, really leads Baba to have a significant amount of upside potential here from a valuation perspective. So for those reasons, we think that the upside potential here for stocks like these Chinese tech stocks are fairly significant. And that's really why they belong on our list here right now in these kind of more fragile environments to take a look at some of these particular stocks. Another one is another Chinese stock, a Chinese retailer, PDD. We'll take a look at this on a more granular basis here as well. This stock has been really range bound for quite some time, but notice how it's really started to trend higher here over the past couple of weeks. And exactly what we're looking for is really kind of the breakout here above 112. We broke out, pulled all the way back here, and we're kind of back towards potentially a double top here on PDD. Trading at 9 times forward earnings. A lot of questions that I've gotten about this particular stock have been around, aren't you concerned about tariffs, which is directly aimed at companies like this? And you're absolutely right. The risks are there with tariffs with stocks like this, but I would say that those risks are currently reflected in its valuation. PDD is expecting to grow top and bottom line by about 30%, yet it trades at 9 times forward earnings. Net margins are, exceed the industry average. So the fact that they're more profitable and growing substantially on both top and bottom line justifies a pretty substantial premium valuation, yet it trades at a valuation that's more than 50% below the industry median. So for those reasons, I think PDD, despite the risks, is one of the more attractive plays from a valuation perspective, and presents an interesting upside opportunity here uh, for equities. And then lastly, Baidu, the other Chinese tech company, big move here yesterday here. We basically were looking for this breakout here above 96, and that's exactly what we got yesterday. And we're looking for a continuation higher here towards at least 116 here to the upside. So in these type of market environments, looking at international equities is really kind of where the performance currently is. And as China kind of moves with this deregulation push that they've been promoting for the last few weeks, we're starting to see a lot of these Chinese stocks that have been trading at rock bottom valuations for years starting to show a path for shareholders to unlock some of that value closer to, the valuation that its American counterparts trade at right now. So it certainly represents where one segment where I think there's a fair amount of opportunity here. On the flip side, if you look domestically, Stocks like Visa recently pulled back to some major support levels here around 320 or so, and looking for that potential bounce higher from here. And this is all about trying to skew the risk to reward as much in your favor as possible in these type of market conditions. We don't know where the markets are going. It could potentially head south fast. So what we want to do is we want to make sure that we take positions in stocks that are timed correctly, meaning the risk to reward are most favorable to us and have strong valuations, because then the downside risks is more limited if something is trading at a much more reasonable or even undervalued as an underlying stock. Um, some other ones to pay attention to here right now. Meta recently pulled back here to a major support level here around 580 or so. Meta is currently trading at only about 24 times forward earnings. So if you consider the fact that Meta is expected to grow top and bottom line, that's slightly above industry average, but net margins that are approaching 35%. The fact that it only trades at 23, 24 times forward earnings is pretty inexpensive, given the growth expectations and how profitable they are for every dollar they generate in revenue. They are earning, 35 cents in net income. That's nothing to sneeze at, and it justifies, in my opinion, a higher valuation for Meta. Um, some of the banks that we're starting to see, Bank of America here pulled back to a major support level and starting to bounce higher here. We're looking for that continuation back up towards 47 here. Bank of America, one of the cheaper banks, trading at about 1.3 times book value versus stocks like JP Morgan trading at 2.5, 2.6 times book value. So from a valuation perspective, stocks like Bank of America are far more better aligned from a valuation perspective that align with the the overall market conditions that we find ourselves in. Um, Newmont Mining, you have gold approaching new all-time highs, and Newmont Mining approaching this $48 double top. A breakout here above 48 would really start bringing us towards, potentially 57 here to the upside. As gold approaches all-time highs or makes new all-time highs, mining stocks like Newmont Mining that are outperforming the S&P 500 right now have a good shot of that breakout and continuing higher from here. Amgen, healthcare stock that has pulled back here again, also to a major support level here, broke out above 305, traded all the way up to 335, came back to retest this level of support, potential opportunity to look for that bounce towards 335. And probably the last one that I think I will take a look at on the long side is NVIDIA. NVIDIA has gotten back towards this 105 level, which has been a major support level multiple times in the past. It bounced off of those levels. And obviously, trends have started to deteriorate a little bit here for semis, but we really need to see stocks like NVIDIA hold these major support levels in order for the overall market to maintain a more neutral view. If NVIDIA stocks like NVIDIA start to fall apart, then that definitely reflects a much weaker overall market and concerns around investing in U.S. domestic equities. So we're keeping a very close eye here on NVIDIA, trading at about 25 times forward earnings, which is just downright cheap if you consider the fact that NVIDIA's expecting to grow top and bottom line by 30% with net margins that are north of 55%. So, you do have stocks that are growing at 30%, and you do have stocks with net margins in the 50, 55% range, but you rarely have both. So the fact that NVIDIA is growing so fast and is so profitable and only trades at 25 times forward earnings represents, in my opinion, within the Magnificent Seven, the most undervalued stock in tech at the moment. And on the flip side, if you look at Apple, Apple's trading at 31, 32, 31 times forward earnings. Even though it's taken quite a bit of a hit here over the last few weeks, I've continued to pound the table here on Apple. I think this breakdown here below 220 is concerning for further downside. We just got news this week that Apple Intelligence, their AI toolkit that they were meant to launch with iPhone 16, but really bundled that particular launch. We were expecting to see sort of the major release of Apple AI in the spring of this year. We just got news earlier this week that that's likely not going to happen in 2025, that we're likely going to see that in 2026. So this really pushes Apple further behind the AI curve as it kind of continues to rely on other parties with OpenAI for their Apple Intelligence, which is also going to affect the next upgrade cycle. Um, there was a lot of anticipation in AI kind of driving value and unlocking value for Apple, especially with the iPhone 16. Expectations were high. So far, they've had to dial back those expectations significantly. Apple 16, from a revenue perspective, is only increased from the previous model by about 1.5% so far in terms of revenue. So the growth here for iPhone 16s have been just not there. And now that without Apple Intelligence coming out for for iPhone 16, nor will it be really included for iPhone 17, that's really where I think this gets quite concerning here for Apple, because the valuation that it trades at is a rich one, and incorporates kind of some of this type of advanced capabilities into their product line. So the fact that we're getting delays further on that is not good. And then you factor into a slowing U.S. consumer. You see the Vision Pro, which is meant to be their next big um, project and technology for future growth. We've seen that be somewhat of a flop with regards to sales, and certainly a flop with regards to developers working on that specific product. And at the same time, Meta and Snapchat have introduced smart glasses that do obviously not as much as Apple's Vision Pro, but is far more commercial ready for everyday use. So for those reasons, Apple trading at 31, 32 times forward earnings with kind of much more bleaker prospects represents, in my opinion, the most overvalued stock here of the Magnificent Seven in terms of tech stocks. So, I'm taking an approach where I'm short Apple and long stocks like Nvidia. You can do that utilizing options like selling call spreads on Apple, like we've been doing over the last few weeks, and then by selling some put spreads on Nvidia to kind of give you a bit of a pairs trade here, if you will, by collecting premium on both sides, long Nvidia and short Apple. Um, so that covers what I wanted to share with you here today. We covered a lot. This is really a pivotal week here for equities, especially with the FOMC meeting tomorrow. So keep an eye out on some of the important levels that are referred to on the S&P 500, and that'll give you some clues as to who is maintaining control here for the broader markets. And that will largely inform which side of the market you'll be trading opportunities on. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.